In 2025, approximately 85,000 Calgary households will face mortgage renewals, joining over 1 million other Canadian homeowners. But what if I told you this could be the perfect time to upgrade your home instead, if that is something you're considering? Let's look at some scenarios if you're weighing out your options. Now, I know for our family, when it came time to renew our mortgage, about 4 years ago, that is when we made a move to a larger home for our growing family. So I understand what you may be going through, whether you're thinking of upsizing, staying put in your home, or downsizing as life kind of continues to change for you. I didn't face the large possible increase of interest rates that you may be facing at this time, so let's look at some pros and cons and jump into the mortgage spreadsheet to see how some numbers actually play out. So let's talk about renewing your mortgage. This is you staying in your property, not moving, and just renewing your mortgage. Now, you could end up seeing some interest rates increasing quite a bit. We'll get to those numbers in a moment. But first, the biggest reason you may want to stay in your current property is the fact that things are a little bit tight financially. Staying put instead of moving is really, really important, unless you're maybe downsizing, not just like downsizing the size of your house, but keeping your same price. But if you're actually downsizing your home and your mortgage, this could also be a good time to move. However, if you just want to stay put, there's a few reasons that this could be a very vital thing for you to do. The first one is job security. If you just don't have real strong job security going into the next 3, 4, 5 years, renewing your mortgage and just kind of staying put could be really, really smart. There's economic uncertainty. If all of the things that are happening in the US and Canada, all the things that are just happening around the world, just politically, oh my goodness, politically, financially, all of this, and it's just too much to kind of bear, then maybe just staying where you are is also a good reason. And the real thing too is that you just might not actually need more space. You might not need less space. So stay where you are, because if you don't move, you don't have moving costs. You don't have costs of an agent like ourselves. You don't have costs of the movers. You don't have costs of so many other things, but you don't have any of those fees and costs that you're going to kind of have to pay. Because when things get tight, people like us, we rise to the occasion, and maybe renewing is exactly that thing. The other thing too is if financially things are a little bit tight, the stress test has actually been waived for your renewal. So if you were going to renew your mortgage, the stress test is taking the interest rate plus 2%. You have to qualify for that plus 2%. So if your financial situation is a little bit tighter, it might be better to just stay, because then you don't have to re-qualify with that stress test. And surprisingly, some people are kind of forgetting that they have to do this when they go to a new property, because they don't have to do it when they go and renew their current property. As affordability has been such a big topic for 2024, one of the things that you may want to consider is actually staying in your home and putting a suite in it. So there's some new mortgage rules that came out very, very late 2024 that allows you to actually take a higher LTV, which is a loan to value. So before, you were typically only ever able to loan up to 80% of your value of your home to do certain things. However, or to do whatever you want, really. You could just take the money out, but please don't do that. We do not do that. People like us, you, me, we do not do that. Leave that equity in your property. Don't leverage yourself. Don't get into situations that just make it too tight for you and your family. It's not worth it. However, if you're going to invest that money, that could be a little bit different. And one of the things that came out was a 90% loan to value. So your value has gone up, right? So if this is your 2025, you bought or you renewed your mortgage in 2020, the average property, the benchmark price, went up from $500,000 to about $750,000. So there is equity in your home. And if you want to all of a sudden kind of stay in your property and you've thought about having that extra income and put a suite in there, well, there's many, many options to do this now. And that 90% loan to value is specifically for you improving your property and using it for a suite. So this could be something great. When we look at the mortgage information here, this is potentially what your property looked like back 5 years ago. So let's use an example of your detached home was $550,000 back in 2020. You bought it with 10% down, you did all your CMHC, and you're able to get a 1.8% interest. You do 25 years, property taxes. I mean, this is total numbers, so I know things have changed and it'll be a little bit different, but these are just scenarios, right? And so you had about $110,000, net monthly was $6,300, and your total cost was $2,600 a month. So that's your total cost of your property, with mortgage being about $2,200 a month, okay? But all in, you're about $2,600 a month. So at the end of the 5 years, which is this year, 2025, you would have a mortgage of approximately $425,000 left on that property. But your value is not still $550,000. Your value has roughly gone up $250,000. So we're sitting at $800,000 for your value of your home approximately. Now, if you are the city of Calgary, you decided to think that that's probably $880,000, but that's for another video. And if you end up looking at what the value is, you end up having about $376,000 in equity because your mortgage is roughly $425,000, right? So now if we change this to about a 4.4% interest rate, and you don't want to renew at 25 years, you want to renew at 20 years because you want to get rid of the mortgage and keep paying it down. Well, now your monthly cost has gone up to about $3,300 per month. So we can see $700 a month increase that you are going to expect if you plan on renewing. Everything else has stayed the same in terms of your income, all that kind of stuff, and just you're here where you are, right? Insurance actually probably has gone up a little bit, so let's say $3,000, but at the end of the day, it's maybe $50 a month. So you're about $3,300, $3,400 a month increase, $700 to $800 just on renewing your mortgage. Now, you don't have to do a stress test. You don't have to do anything. As long as your income qualifies for this home, you can renew. Now, here's the thing. If your income doesn't qualify for this, you have to move, or you have to figure out how to get someone on the mortgage. And that's where things get a little bit tricky right now. We're not going to go into those scenarios, but just be aware of that and talk with your lender to see if everything is going to be okay with your current financial situation. So one of the big things that I continue to hear is people saying, don't buy, just hold off. There's going to be this flood of inventory coming to the market, and I don't know if that's going to be completely true, because we could see more inventory coming to our market, which means there will be more homes than what is needed, but I don't think we're going to see that for too long. There might be little peaks throughout the year, but we're not going to see just this flood of inventory. Now, we know many buyers that have been sitting on the sidelines waiting for the right properties, and even like over the last couple weeks into 2025 here, we've seen multiple offers. Our team has had a few listings, detached townhomes, that have gone into 6, 7, 8 offers on a single property. There's still just not a lot of inventory. You have to remember, we added a ton of people to our city. I've seen reports anywhere from some reports saying 45-ish thousand last year, all the way up to 100,000. There was something in the Globe and Mail that said that. And I don't know which one's correct. I don't know the true numbers. Regardless, let's say it's 50,000. We added 50,000 people to our city last year. That's a lot of people to house. So if you're planning on not staying and you want to consider buying something different, let's kind of play out that scenario. For $800,000, right now, you are probably sitting in roughly a 2,000 square foot property. 1,900, 2,100, 1,800, somewhere in there is probably the square footage of your home at $800,000. And as you can see on the map, this is where all the sales that happened recently that were between, I think, 790 and 810. So it just shows you that there's a lot of suburb options for that price range. Now, that's you selling. That doesn't mean that's what you're going to be buying. Now, if you end up going up value up to $925, because you're kind of increasing your value and increasing your mortgage and buying and upsizing to a new property, what you'll see is the map shifts. It turns into more inner city. So here's two things that could happen when you are actually moving up. You're not necessarily getting more space, you're getting into, like I said before, you're getting into a better position. So sometimes buying inner city or some of these inner city neighborhoods, you're gonna have similar 2,000 square feet, but your value is up more than what it was from where you're selling. Just one scenario. There's plenty to play with here, but that's just one example. The other option is if you are actually needing more space versus just moving into a more mature area from something that's a suburb like Nolan Hill or Auburn Bay or whatever it is. But if you're actually wanting more space in your property and you stay in those suburbs, you could actually end up seeing maybe 2,400 square feet for around $925,000. So when you're looking at the mortgage calculator here for the data, you have a $925,000 purchase. Let's say you find another property, you actually have about $370,000 down because of the equity in your current home. So that's going to be, now this is before fees and everything else. Again, this is just scenario making everything easy. You have about 40% down on your next property, which is awesome. So interest rate, you're going to be, again, around that 4.4%. Let's just keep it the same. And 25 years amortization. So your total cost is going to be $3,861. So it is $500 more than your renewal, but you're in a better property. And you might be in a place where adding that much per month is going to be okay. And this is something you want to do. However, there's a few mortgage rules that have changed that could help you as well. And I want to say before I give this example, please use an agent when you're going to builders. So when you go to a builder and you buy a new home, you can actually get 30 years amortization. Now, some people are hating on this, some people love it. I'm in the middle. I know that we used it in some of our first homes when we were able to do 30-year amortizations to allow us to have lower rates. We didn't stay there forever. We paid down our mortgage and we kind of did the right things, and now we're sitting much lower than that in terms of the amortization, what we have left on the property. However, this is an option. So if you go from 25 years, you're at $3,861. You go to 30 years, you're at $35. So now you're actually only about $100 more for a property, a new build, compared to renewing your current home. That's kind of interesting. Now, there's a lot of new builds that have suites in them, and there's a lot of new builds you can get suites in them as well. So there's a couple scenarios we could play. So let's say you end up finding a property and it has a suite in it, but you end up having to pay maybe $950 for that property, not $95,000. You end up paying $950,000 for that property, and you end up being able to have a rental rate of $1,400 a month come in. Well, your adjusted mortgage payment is now $2,559 after you have rented out your basement suite. So you just upsized. You went from your $800,000 home up to a $950,000 home, and you have a basement suite in it, and you are paying what you were paying for the last 5 years in your monthly payments when you had a 1.8% Like, that's crazy. If you currently live in something like a condo or a townhouse and you want to upsize to a townhouse or maybe a detached property, positioning yourself is very, very important when you move up to the next property. So here's our example. 4 years ago when we moved from a smaller bungalow into kind of a 2-story property. And it was very, very intentional. We chose a handful of communities we wanted to live in that were close to where our girls went to school, things like that, and where our life was. And we intentionally chose a certain neighborhood that we knew would have a lot of appeal in the future. And we moved from a neighborhood that had a lot of appeal, but where we were moving to had more appeal. So we strategically kind of made those decisions, and that's something we can help you with. Anywhere in the city, there's options like this. Doing this strategy every time you move can just continue to build equity and put you in a better position for your family and financially for your own property. So when you're making that move and you're finally planning on moving up to a different property, you might not always move up, you might downsize. And so buying a different property in this market could be something that could be really, really advantageous for you because it's your year of renewal. There's no fees. A lot of times you're able to get out of your mortgage or work with your lender within that year, calendar year of your renewal. So start talking to your mortgage broker, start talking to that lender directly, and start understanding what your options are. Because whether you're planning on upsizing, whether you're planning, so getting a bigger property, needs for your family, or you're changing to a different location because the place that you bought isn't exactly where you want to live right now. It doesn't meet your current lifestyle, where you're working, where your kids are going to school, whatever it is. Or you might be in a place where you need to downsize. Kids have finally left, they're gone, and you just have too much space and you want to downsize into a different property. Well, maybe this is going to be a great time for that too. So regardless of whether you are planning on renewing or if you're planning on buying, the benefits of locking in at the current rates over this next year is going to be really good. We do not know what 2026, 2027, and 2028 are going to look like. We have no idea. And finally, regardless of your renewing or your buying, there are some lenders who are fairly aggressive in getting your business right now. Someone like Scotiabank, just this week, I heard they are pretty aggressive on their 5-year or 3-year fixed rates, where they're getting almost 4%, 4.09, I think is what I saw. So there are some lenders that are really wanting people's business. And so use that as leverage. Like, talk to your lender, shop around, regardless of staying or moving, because there's a lot of lenders that are open to figuring it out with you. So when we made our move, like I said before, we had to look at life decisions, what we wanted our life to look like, how we wanted our family to function in a home. And we also wanted to figure out, how are we going to experience this property? How are we going to experience each other? And how are we going to experience the friends that our kids have? And how are we going to host? Like all these things, right? So these are all visions of who we want to be and how can a home and a property help us achieve that. And so one thing that was very, very important for both Rebecca and I was being able to have a house where all of our girls' friends, not girlfriends. I don't have a girlfriend. My wife is my girlfriend. All of our girls' friends could come over and hang out. And we could have a property where they are hosting their friends, because it was very, very important to us that we got to know our kids' friends, because they're great kids and we want to be an influence on their lives as well. So that was very, very important. And you may be in that same position where you're trying to figure out exactly how you want to make this work. When you look at these numbers, you could actually move up to a brand new home that has a suite in it, do a 30-year amortization, and be paying less on your mortgage than what you've been paying this whole time. Now, caveat, I'm not saying that this is for everybody. And if you are financially tight, please do not do this to think that it's going to be cheaper. Have your, the foundation of your finances ready, good to go, because that's what people like us do. We take care of the things that we need to take care of. Have your savings, have those things. Don't just make these rash decisions and jump to something just because it looks cheaper every month. That's not what I'm saying. What I'm saying here is there are ways and situations that we as agents can help you find the right way to move up to a new home with the things that are available to us. Because if it feels too tight right now, it will feel tighter in the future. So stay put, renew your mortgage, just live your life and make it simple. However, if you still are not sure of what to do and you want to kind of see more reasons why you should not buy in 2025, well, head to that video and we'll see you over there.